If excluding food and energy, prices rose by 0.2, that means food and energy went down because it subtracted or caused the overall number to be lower. And that's exactly what happened. Not so much food, but energy. In particular, gasoline, which was down, I think it was close to 4%. So there was a big decline in the entire energy complex that helped keep the rate at just 0.1. And the year-over-year core was 2.5%. Again, exactly what had been expected, and 0.1% lower than it was the prior month. And the initial reaction to this was at least inflation isn't any worse than the Fed thought, and the odds of a September rate hike went down to just 30%. And at one point, I think it might have been upwards of 70%. But now it's 30% based on the fact that the markets are now reassured by these numbers that the Fed doesn't have to hike. Of course, the numbers are irrelevant. They're backward looking. In fact, more important data on inflation came out later today that I think is far more significant than this backward-looking CPI number, and I'll get to that a bit later in the podcast. But first of all, the reason that the number was still so benign for July was the way they do the accounting. And I had forgotten about this because I had assumed a few weeks ago that the number would be hotter based on the huge rise in the oil price in July. Oil prices were up, 22% or something like that. I think we ended July 82, 83, something like that. We're right around that level right now in energy. Oil prices are about $83 a barrel. We were just below 70 when the month of May ended. But the way they calculate the CPI, they don't compare the price of gasoline or heating oil or any of these energy components. They don't compare the month end. They don't take the end of June and then the end of July. Because if they did that, the numbers would have been way up. What they do is they take the average price for both months and they compare that. So because we had this huge collapse in the month of June, and prices started the month of July so low, even though they ended much higher, the net effect when you compare the average of the 2 months showed that prices were down. But that's irrelevant, because what that means is that the July number, is still being heavily influenced by the big drop in oil prices that we had in June, and it's really not reflecting the surge in oil prices that we had in July. So I think the number in and of itself is pretty meaningless. And it also indicates that the August number now is going to be much worse, even if oil prices just stay where they are. They don't keep going up. The average in August is going to be a lot higher than the average in July. But I don't think oil prices are going to stay where they are. I think they're going to keep on rising, and I'll get into that a little later in the podcast. What I want to talk more about is what should have been more significant in the minds of investors as far as news that came out today on inflation in the future, which of course is what really counts. When you're an investor, it's future inflation that is going to be your enemy, especially if you're a bond investor. And in fact, the bond market, before I even get to this, the bond market didn't even rally on this number. And then it actually sold off a bit, and yields ended up higher on the day. I mean, it wasn't a collapse in bond prices. The yield on the 30-year looks like it went out at 5.25, and on the 10-year at 4.69, but very little movement down. Even though the odds of rate hikes went down, the long-term bonds did not benefit from the supposed good news that the inflation numbers weren't worse than expected. And again, even if they weren't worse than expected, they were still bad. The year-over-year core is still up 2.5%. That's significantly higher, 25% higher to be exact, than the Fed's 2% target. And of course, that number had the benefit of falling oil prices that, you're not going to have that benefit in future months. So, but even taken at face value, it's not a good number. And year over year, the headline number is 3.4. How does that square with a Fed that claims that its goal is 2%? 2% inflation, we're at 3.4, and supposedly that means the Fed doesn't have to hike rates. But what it actually shows is if the Fed doesn't hike rates, that 3.4 number is going up, not down. So a rate hike is not only appropriate, but it's long overdue. And in fact, a rate hike significantly greater than the 25 basis points, which would be the most anybody would be looking for, is appropriate. And was the Treasury statement that came out later in the day, I think around 2 o'clock Eastern time, is when they released that. And this is the official budget deficit for the month of July. And the deficit came in at $432 billion. That's 1 month. I mean, I remember that was a bad year when the government ran a $400 billion deficit for an entire year. That was a reason to be concerned. Now, that's the red ink that was chalked up just in the month of July. That is an all-time record. There has never been a July in the history of the country where the deficit was that big in the month of July. It was an 18% increase in the July deficit from a year ago. So when you're comparing, month to month, all of the other factors are evened out with respect to when the government receives money coming in from taxes and spends money. So an 18% increase. The total deficit now for the fiscal year was reported at $1.7999 trillion. So call it $1.8 trillion. That's in 10 months. So there's still 2 months left of the fiscal year, but this fiscal year, 2026, already tops 2025 with 2 months to spare. And by the way, again, this is all a bunch of government accounting, because during the 10 months where the official deficit was 1.8 trillion, the national debt rose during those identical 10 months by more than 2.1 trillion. So 300 billion more increase in the debt than the official deficit during the same period of time. Now you might want to say, well, how's that possible? Because if the debt went up, the government must have borrowed the money. They did borrow the money. They just pretend that they didn't, because the official numbers only reflect what's on the budget. So in other words, the government has a budget, and according to that budget, they plan what they're going to spend. But if they end up spending money that they didn't plan on, then it doesn't count. I mean, it actually counts because they still have to borrow it. That's why it shows up in the national debt. But when they report the official deficit numbers,